All right, so welcome back, everyone. So I hope you had some very interesting discussions and networking in the breakout rooms, or took a really good break to get your energy for this very exciting second session. So we have two papers. Let's welcome Leon, who will be presenting acquisitions and CEO compensation changes.
Hi, thank you. So you can see my screen okay?
Yes.
Excellent. So thank you for the opportunity to present today. And also a special thanks to the organizers for pulling together the conference despite some pretty serious hurdles over the last year. Now, this paper is joint work with Dave Dennis at the University of Pittsburgh. And so in the paper, we first examined CEO compensation changes in acquiring firms around acquisition announcements. We then ask if CEOs use acquisitions as an excuse to pay themselves more, as suggested in the cartoon here, or if there's an alternative explanation that's more consistent with the evidence. Now, based on a 2017 Economist article, Buttonwood seems to favor the CEO self-interest story. He writes, "It's easy to understand why an executive opts for a deal. Buying another business looks like decisive action and is a lot easier than coming up with a new best-selling product. And being in charge of a much bigger company is a more demanding task that will surely justify a larger salary for the executives in charge." So this opinion is not uncommon. And when you look at the existing evidence, we can see why. So for example, Grinstein and Rybar find that acquisitions are associated with higher bonuses that are unrelated to deal performance. And Harford and Lee find that post-acquisition CEO pay is insensitive to negative performance, but possibly associated with positive performance. So it looks sort of like an option for the CEOs, a call option. And then Yim finds that acquisitions are associated with permanent increases in CEO compensation. So we're going to build on this prior work in several dimensions. So first of all, we examine the robustness of the link between CEO compensation and acquisitions across time and also across method of payment. We're also going to examine which components of CEO compensation increase. Is it salary? Is it bonus? Or is it equity-based compensation? And second, we're going to examine two hypotheses for the observed CEO compensation increases. The first is the agency hypothesis, the hypothesis that underlies Buttonwood's concerns. And the second is a novel hypothesis we call the dual adverse selection hypothesis. So it posits an acquirer who's faced with uncertainty, the target firm valuation, will prefer to use stock as payment in the deal. The target shareholders, on the other hand, are concerned about uncertainty in the value of the acquirer shares and prefer not to have stock as the method of payment. So what happens is the acquirer CEO steps in and eases the target shareholders' concerns by accepting a larger portion of compensation, equity-based compensation. And then, so this essentially bonds the CEO to the stock price and credibly signals that the acquired stock is not overvalued. So finally, we're going to examine the cross-sectional patterns in the data and test these hypotheses. So to preview our findings, so first of all, we find that acquisition-related CEO compensation increases in the first half of the sample, but the increases drop sharply in the latter half of the sample and lose significance. We also find that CEO compensation increases are driven by deals in which the method of payment is all stock. So we only see this in the all stock deals. And we also note that the frequency of all stock deals drops from 23% in the first half of the sample period down to about 6% in the latter half of the sample period. And this contributes to the loss of significance in the second half of the sample period. And we further find that CEO compensation increases come in the form of equity-based compensation. Now, in the second part of the analysis, we examine how CEO compensation increases vary across bidder and deal characteristics. And we find that compensation increases are driven by, first of all, acquirers with low board capture, acquire CEOs with low excess compensation prior to the deal, acquire CEOs with low exposure to the stock price prior to the deal, riskier acquirers, and riskier acquisitions. And these findings are consistent with the dual adverse selection hypothesis, but not with the agency hypothesis. Okay, so to briefly introduce the sample, we start with CompuStat firms from 1993 to 2018. We then use SDC to identify significant acquisitions, and we define a significant acquisition as the target firm being at least 5% the size of the acquirer. And the data for compensation, CEO compensation, comes from ExecuComp, and the return data is from CRISP. We also use some CompuStat data as well. So this leaves the base sample. So when we impose that we have CEO compensation data, it leaves the base sample of 47,000 firm years, and about 5,300 of these firm years have a significant acquisition. Okay, so We begin our analysis by cutting sample into two periods. So the 1993 to 2005 period and the 2006 to 2018 period. And we look at acquisition related CEO compensation in each period. So the dependent variable here is change in CEO compensation in all regressions. And the variable of interest is an indicator for announcement of a 5% deal that is subsequently completed. So did they announce a deal in that year that was subsequently completed? So what do we find? We find that 5% deals are associated with significant increases in CEO compensation of around 8% higher in the first half of the sample period. And this is consistent with YIM. And we find similar results when we look, if we include an indicator for prior year deal announcements as well. However, we do not find significant increases in the second half of the sample period. The magnitude drops and it's not significant as well. Okay, so we next break down the deals into three groups based on method of payment, all stock, all cash, and mixed. And we find that increases in compensation that we see in the first half of the period are specific to all stock deals. Okay, and this holds whether or not we separate deals into completed and withdrawn or not, but it's only in all stock deals. Now, in the second half of the period, we observed a substantial increase in CEO compensation for all stock deals of around 10 to 11%, but the increase is not statistically significant. And as we know, a sharp drop in the frequency of all stock deals contributes to this lack of significance. And this drop is consistent with the findings of Debat, Cousin, Roll, and also Boone, Lee, and Liu. And specifically in our case, we find that the all stock takeovers dropped from about 22.5% of the takeovers in the first half of the sample to around 6.1% in the second half of the sample. All right, so we then break down the changes in CEO compensation into its component parts. So change in salary, change in bonus, and change in equity. And then we further break down the change in equity into its component parts, change in stock, and change in options. And what we find is that the increase in CEO compensation that we observe in all stock deals is driven by the equity-based compensation. We find significance in both the change in stock and the change in options. Okay, so just to summarize the key findings of part one, we confirm that CEO increases in CEO compensation are associated with acquisitions, but these increases drop sharply in the second half of the period. We find the CEO compensation increases are specific to all stock deals, and that the frequency of all stock deals drops sharply in the latter half of the sample period. And we also find that compensation increases in all stock deals are paid through equity-based compensation. So we now move on to the second part of the paper where we investigate why CEO compensation increases in all stock deals. Now to address this question, we introduce two hypotheses. The first is the agency hypothesis, which posits that you have an entrenched CEO and the CEO wants to pursue acquisitions because they want to increase the size of their empires. The CEO chooses to use stock as the method of payment to avoid potential scrutiny and discipline from the market associated with external financing. And then, as Buttonwood suggests, they then use their influence over the board and the excuse of a more demanding job to boost their own compensation. So the agency hypothesis leads to a couple of empirical predictions. First of all, the compensation increases should be concentrated in acquirers with entrenched, highly compensated CEOs who exert a lot of power over their boards. And secondly, the increases in CEO compensation will be paid in the form of non-equity-based compensation that's less sensitive to firm performance. So the second hypothesis is the dual adverse selection hypothesis, which ties together several existing threads of M&A theory. So it posits that you have an acquirer, and this acquirer is particularly concerned about adverse selection resulting from asymmetric information in the valuation of the target firm. Well, this acquirer will choose to use stock as the method of payment in the acquisition. However, the target firm, let's assume they're concerned about overvaluation of the acquiring firm's stock. They don't want to accept stock as payment because potential overvaluation. So to mitigate the target firm's concerns, the CEO of the acquirer steps in and accepts a larger proportion of compensation in the form of equity-based compensation. So this essentially binds the acquirer CEO to the stock price and signals to the target firm that the CEO of the acquirer, who presumably has better information than anyone else about the value of the acquirer, does not feel the stock is overvalued. And finally, as a result of the greater equity-based compensation, the CEO's exposure to undiversifiable risk increases and the certainty equivalent value of their compensation decreases. Therefore, the CEO's expected compensation has to increase to satisfy their participation constraint. Okay, so the dash hypothesis leads to several testable predictions. First of all, what we look at is the CEO compensation increases in all stock deals will be largest when, first of all, uncertainty in the deal value is high. Second of all, when uncertainty in the acquirer stock value is high, so the target needs to be convinced the stock is not overvalued. And also when the CEO's prior exposure to the stock price is low. So this is the case when the CEOs would need to be bonded to that stock price because they're not already bonded to the stock price. In addition, the dash hypothesis predicts that the increases in CEO compensation will be paid in equity-based compensation. As we've already seen, this is the case. Okay, so in the second part of the analysis, we address the question, as I said, what motivates CEO compensation increases in these all-stock deals that we see? Now, this analysis is a bit more challenging to present, so please bear with me. Let me go through a little precisely here. So what we do is we first isolate the types of all-stock deals in which CEO compensation increases are hypothesized to be concentrated. So we're going to select variables measuring the key characteristics of interest, and then we convert each continuous variable into a dichotomous high-low indicator. Okay, now, within each type of each variable of interest, so the high type and the low type, we test if the CEO compensation increases in all stock deals of this type are greater than the CEO compensation increases in non-deal years of this type, or in all cash deal years of this type, or in mixed deals years of this type. So just as an example, one variable of interest that we're going to see is excess CEO compensation before the deal. So what we do is we cut firms into above and below average, below median excess CEO compensation. Then within the low excess CEO compensation firms, we test if CEO compensation increases are greater in all stock deal years than in non-deal years, all stock deal years than in all cash deal years, and all stock deal years than in mixed deal years. Okay, so that's for the low type excess CEO compensation. Then we repeat this process for high excess CEO compensation firms. And then finally, we compare these to these results, the predictions for our hypotheses. So we do this for 10 different variables. And the first set of variables is related to CEO compensation. So we use excess CEO compensation in the year before the deal, as we just discussed. We then use CEO delta and CEO vega to indicate the CEO's exposure to the stock price before the deal. So were they bonded to the stock price before the deal? Then the second set of variables is related to the acquirer's board structure. So captured board measures the fraction of directors after the current CEO took over, that were appointed after the current CEO took over. And also we include classified board. The third set of variables we're going to look at is related to acquirer risk. So we use the standard deviation of market adjusted return of the acquiring firm. And we also use investment grade as our two measures of acquirer risk. I want to note here that acquirer risk is greater when investment grade equals 0. So it's going to be the low type variable for investment grade. We're going to see a higher acquirer risk. And the last set of variables is related to deal risk. So we use absolute value of DGTW abnormal return to measure the magnitude of the change in the market's perception of the deal's value during the 1-year period after the initial announcement of the deal. So did the market reevaluate the value of this deal in the next year, and how big was that reevaluation? We're going to use excess change in implied volatility to measure the market's perception of the change in the expected risk of the firm over the year. And then we're going to use the change in standard deviation returns to measure the ex post change in risk from the 1-year period prior to the announcement to the 1-year period after the deal announcement. Okay, so the next 4 slides are going to summarize the regression results for the 4 sets of variables. Now, for ease of presentation, I only present the sign and significance of the variable of interest from the regression estimates, because we just got a lot of regressions that I need to present here. So the dependent variable in each regression is change in CEO compensation. And the specific variable of interest is listed at the top of each column up here. Now, as far as the structure of the table, so the top panel of the table compares deal years with specific method of payment, all stock, all cash, or mixed, to non-deal years. And this is from the table 7 analysis in the paper. And the bottom panel compares deal years with all stock payment to all cash payment, and deal years with all stock payment to mixed deal payment. This is from table 8 in the paper. And then within each panel, the top of the panel has the analysis for the low type below median firms, and the bottom of each panel has the analysis for the high type, the above median type of each firm. Okay, so in this particular table, we examine the 3 CEO compensation variables. And when we look at excess CEO compensation, we see that the increases in CEO compensation for all stock deals are concentrated in CEOs with below median excess compensation. Okay, so these results are the exactly opposite of what you expect. On the agency theory, we'd expect an entrenched CEO who has power to use an all-stock merger to increase their own compensation to be highly compensated to begin with before the deal. Now, when we look at CEO Delta and CEO Vega, we find that higher compensation in the all-stock deals is associated with low exposure to the stock price, low prior exposure. And this is consistent with the dual adverse selection hypothesis. There's a greater need to bond the CEO of the stock price by increasing their equity-based compensation when the CEO has low exposure to the stock price to begin with. All right, we next examine the acquire board variables. And when we look at board capture, we find that the increases in CEO compensation are associated with all stock deals are driven by firms with low board capture, so the non-captured boards. That's where we see the large increases in compensation. Under the agency hypothesis, we'd expect the opposite. We would expect captured boards to give the entrenched CEO a larger increase in compensation. In the third table, we look at the acquire risk variables. And so we here, the evidence suggests that greater increases in CEO compensation in all stock deals are associated with riskier acquirers. Specifically, we find greater increases for the non-investment grade acquirers, the low type in this case, where the investment grade dummy equals 0. And this evidence is consistent with the dual adverse selection hypothesis. And then finally, we look at the deal risk variables, and the evidence here suggests that the greater increases in CEO compensation in all stock deals are associated with riskier deals, the high type risk. Specifically, we find greater increases for deals with above average variation in the 1-year post-announcement returns, and also above average increases in implied volatility. So again, this evidence is consistent with the dual adverse selection hypothesis. Okay, so to just summarize the cross-sectional results, we find that greater increases in CEO compensation are associated with CEOs with lower excess compensation before the deal and acquirers with low board capture. These are both inconsistent with the agency hypothesis. We also find that greater increases in CEO compensation are associated with CEOs with low prior exposure to the stock price, riskier acquirers, and riskier deals. And all 3 of these are consistent with the dual adverse selection hypothesis. Okay, so in table 9, what we do is we separate the table 7 and 8 analysis that I just showed you into the component parts of CEO compensation. So we separate into salary, bonus, and equity respectively. So it's a bit unwieldy to present this table. It's got 3 times as many regressions as the last table. So I'm just going to summarize the results. The results are very easy to summarize. They're very consistent. So we find that the cross-section results for the changes in CEO compensation are driven almost entirely by changes in equity-based compensation. So we see this really focused in the equity-based compensation. Now, given that it's driven by the equity-based compensation, we then ask the question, if increases in equity-based compensation in these all-stock deals is associated with increases or decreases in firm value. And so to measure returns, what we're going to do is we're going to look at returns to measure the changes in firm value. We're going to use the 3-day CARs around the announcement as one measure. We're also going to use the DGTW abnormal returns from the 1 month before the announcement to 12 months after the announcement as our measure of long-term returns. And we're going to include a indicator variable for equity-based, there was an increase in equity-based compensation. And we're also going to interact that indicator variable with all stock and with mixed deals. Now, in this analysis, we only include deal years in which there was a deal, or years in which there was a deal, and the excluded group here are the all cash deals. Okay, so the test of interest here are the F tests down at the bottom. So what the F tests do is so within the group of all stock deals, it asks the question, is there a difference in returns for the all stock deals in which there was an increase in equity-based compensation versus those all stock deals in which there was not an increase in equity-based compensation. And so what we find is that when we look at the cars, there's no difference in the cars for deals with increase in equity-based compensation versus the others. And this is not surprising, given that the market probably doesn't know the change in the CEO's compensation structure at the time of the announcement of the deal. However, we do find, when we look at the long-term returns, we do find a significant difference between the increases in CEO equity-based compensation in those deals without. It's higher in those deals where there's an increase in equity-based compensation. So this suggests that these deals, the ones with the CEO equity-based compensation increasing, add long-term value relative to other all-stock deals and are not the result of CEO agency problems and are not associated with overvalued stock. Okay, so just to summarize, first of all, CEO compensation after M&A deals increases significantly in the first half of the sample period, but not in the second half. CEO compensation increases are specific to all stock deals. And as we see, the frequency of all stock deals drops sharply in the second half of the sample. CEO compensation increases are driven by equity-based compensation. And we further find that CEO compensation increases are concentrated in acquirers with low board capture, acquire CEOs with low excess compensation prior to the deal, acquire CEOs with low exposure to the stock price prior to the deal, riskier acquirers, and riskier acquisitions. And these results support the dual adverse selection hypothesis. And so essentially, the evidence favors an efficient contracting story over the CEO self-interest story. All right, well, thank you very much, and I look forward to the comments.
Okay, perfect timing. So now let's welcome Faye as a discussion for this paper.
Hi, Anne. Hi, everyone. Can you see my slides okay?
Yes.
I'm on mute?
No, yeah, we can see your slides. You're good.
Okay, great. All right. Well, thank you so much for the organizer for asking me to discuss this interesting paper. Well, let me start off by saying that I'm so glad that I'm not presenting the paper. And Liang's did an excellent job because there's just so many results and there's so many stories and the side stories that needs to be covered in the paper. So and thankfully, Liang did a fantastic job, so I don't have to go through all that. So what I'm going to do is to first present a quick summary of the main results and the hypothesis, and then I'm going to go into the discussion mode to highlight a few issues that I hope that the authors can further improve upon. So the gist of the paper, well, the starting point of the paper is a very provocative and a novel finding. And that is the previously documented compensation increase following acquisitions. Guess what? It's only present in the first half of the sample period examined in the paper. That is from 1993 to 2005. And then the authors dig further into the fabrics of the results and they find that guess what? Even in the first sub-period that there is a significant increase in compensation after acquisition. The compensation increase is mostly driven by all stock deals, defined as deals where stock payment represents at least 95% of the deal value. And then they further dig into the different components of compensation. They find that the equity-based components experienced a much larger increase following all stock deals compared to salary and bonuses. And then they find their argument or their explanation for why there isn't a significant compensation increase in the second half of the deal is that all stock deals, the percentage or the prevalence declined sharply in the second half, partly due to the abolishment of the pooling accounting method. And as a result, if you look at the average compensation increase following all deals, there's no significant, it's not a surprise that there's no significant compensation increase in the second half. And then the question becomes, how do we make sense of the result that the compensation increase is only driven by all stock deals in the first half of the sample, and most of the increase is concentrated in equity-based compensation? And the author developed two theories. One is the the previously mainstream agency hypothesis. The other is the newly developed the dual adverse selection hypothesis. So Leon did a great job in I was having difficulty coining a name for this hypothesis. So I'm just going to borrow what Leon just came up with, the dash hypothesis. And they find a lot of support for the dash hypothesis. So what is the dash hypothesis? Essentially, it's a double bonding. It's a bonding story. And the idea is that in stock financed deals, acquirers, in stock financed deals, the target shareholders are concerned about accepting overvalued acquired stock. And to mitigate their concerns, the acquirer will say that, how about I give some equity awards to my CEO? The fact that my CEO or my executives are willing to accept these stocks as part of the compensation should send a signal to the target shareholder that my stock is at least not nearly as overvalued as you feared. And of course, when the acquirer give more equity-based compensation to their CEO, the overall risk level of the compensation increased, and the pay level needs to increase to compensate for the higher risk. So that's essentially what the dash hypothesis is. And my overall impressions of the paper is that there's a lot to like about the paper. It starts with a very novel finding, and then it came up with in my opinion, a very creative explanation backed up by a large set of results. And the broader implication of the paper is that it really challenges the current thinking on the dynamics of CEO compensation following acquisitions. And previously, our frame of mind is defined by this agency view, and that's supported by at least the 3 studies that are listed here. But I think, as Leon points out, the results, the tenor of the results presented in the current paper actually points to an optimal contracting, optimal compensation design, a type of interpretation. So that's what I really like about the paper. But I think that there's, as with any paper, there's room for improvement. In particular, in this case, I think both the theoretical parts and the empirical analysis can use more tightening up to become more convincing. So I'm going to go into details about those. And then I'm also going to highlight a few interpretational issues that I have with some of the key results that I think can really go either way in terms of being consistent with both the agency hypothesis as well as the dash hypothesis. And then I'm going to just to touch upon a couple of, in my opinion, unresolved puzzling results in the paper that points to the possibility that in addition to the dash hypothesis, maybe there's some other stories going on as well. Okay. So I'm going to first talk about the theory, which is the main theory of the paper, that is the dash hypothesis. I think the story of that hypothesis makes a lot of sense. But as I read and think more about it, I think it's built on a couple of important building blocks that probably should be more fully or explicitly fleshed out in the development of the hypothesis. Because the dash hypothesis is based on this idea of a bonding mechanism, and the first building block for this bonding mechanism to work is that there's a timing issue that needs to be clearly spelled out and explained. That is, the compensation increase or the compensation change will happen following the acquisition. And during for the acquirers to use this bonding to convince the target shareholders that acquired stock is not nearly as overvalued, somehow acquirers need to credibly commit to giving their CEOs more equity awards during the merger negotiation before the merger is consummated. So how is this accomplished is not clear. And there are, as I think about it, there are 2 ways for the credible commitment to take place. One would be the explicit mechanism. That is, maybe there are some contractual terms included in the merger discussion or merger agreement related to how much the acquired CEO will get paid and in what form after the acquisition. So if the author can dig into some of the follow some of the literature, recent development in the merger acquisition literature, and look at the details of the merger agreement, if they can present even a set of evidence related to this, I think that would be very, very helpful. And in addition to the explicit, contractual commitment to giving CEOs more equity pay, and another mechanism for this to work maybe is that the acquirers can make an implicit promise to the target management that after the completion of the merger, we're going to give our CEO more stock and stock options to bond them. But this would rely on reputation building in a repeated game setting, right? And this is not necessarily applicable to the mergers and acquisition setup, because as we all know, mergers and acquisitions represent a rather rare corporate events. So here my suggestion is that maybe if the author can dig in and focus on those acquirers that are frequent players in the merger acquisition market, maybe for these frequent acquirers, reputation is more important, so they're able to make a credible and implicit promise to target shareholder that we're going to do what we promised you during the merger acquisition, during the merger negotiation. So that's the first building block that I think needs to be highlighted. And then the second part of this bonding mechanism is that for the CEO of the acquirer to accept the overvalued acquirer, potentially overvalued acquired stock, and then for this to have bite to the CEO, I think the new equity awards should substitute for other parts of CEO compensation rather than being purely incremental. Because if the new equity awards are being purely incremental to what the CEO is supposed to earn, yeah. So if I'm getting free money, yes, even if the equity awards are overvalued, even if after I accepted the awards, the value of those shares or those options will decline, still I'm still getting something out of it. So for the acquirer CEO and the target shareholder to be completely aligned in this, I think the equity awards needs to substitute for other parts of the CEO compensation. So here my ask for the authors is that whether there's any evidence that you can find with respect to such substitution that I laid out here. So these are the two building blocks for the dash hypothesis that I'd like to highlight. And then with respect to empirics, the author's focus is on this comparison between all stock deals versus mixed deals and all cash deals. I think as a first initial probe into the data and to see exactly what kind of deals seem to drive the compensation increase, it's natural and it's fine to focus on the all stock deals. But the problems of, in my opinion, the focus on the all stock deals is not directly backed up by the dash theory, because the dash theory actually will apply as long as stock represents a substantial proportion of deal payment, because as long as there's a lot of stocks that's being used to pay a deal, then target shareholders would be rightly concerned about acquired stock being overvalued. So I think the tension, the importance of the variable of importance, in my opinion, should be the percentage of deal value paid by stock, rather than whether a deal is completely financed by stock. If I take a step back, I think alternative would be, let's just focus on deals paid with at least 50% stock. Okay. And then another issue another recommendation that I would like to make with respect to the empirics is that it seems natural to use 2005, 2006 as the midpoint to cut up the entire sample into two periods, but there doesn't seem to be a good theoretical reason for this. And the reason I say this is that the author mentioned that the reason that the drop in all stock deals is because of the abolishment of the pooling accounting in 2001. As a matter of fact, the paper cited by Leon and Dave, by DeBold, Cousin, and Rowe, they found that since the abolishment of the pooling accounting, the all stock deal dropped precipitously from 62% of all transactions in 2000, all of a sudden to 23% in 2003. So the drop or the decline in all stock deal actually happened in 2001. So is there any, should the author maybe at least try to partition the sample at 2001, see how the results will vary? I think that would be a more theoretically motivated. And then I think there's a potential opportunity for the authors to do more with this 2001 as the sample partition point, because you can say that up to 2001, the pooling accounting was a major driver for deals fully financed by stock. And then post 2001, maybe fully stock financed deals are more likely to be driven by overvalued acquired equity. And then this would exactly fall in the domain of the dash hypothesis. So if that's the case, if you focus on post 2011 period, maybe you're able to find stronger support for the dash hypothesis. And a couple of interpretation issues that I have is that, as I mentioned, some of the key results seem consistent with both agency and the dash hypothesis. So I'm going to highlight a couple here. One is that they also documented that the large compensation increase is actually concentrated in low board capture firms. This seems inconsistent with the agency hypothesis, but actually, if you look at this evidence from the lens, this actually is consistent with the agency hypothesis, because the low board capture could reflect newer and younger CEOs who haven't been at the firm for long. And these CEOs, based on the 2013 Sujin Im study in the JFE, these younger CEOs, they have more to gain by using acquisitions to bargain for larger pay raises, because they have a longer career horizon in front of them. And then the second result I would like to talk about here is that the larger compensation increase being concentrated in low equity exposure CEOs. And this again can be consistent with the agency hypothesis, is that the reason is that these CEOs' incentives are less aligned with those shareholders, and they make poor acquisitions, but they seem to they can bargain for larger pay raises and more equity awards even after making these poor acquisitions to come out ahead, or at least not on the short end of the stick. And this is consistent with actually the results and the evidence in the Harvard and Lee 2007 JF study. And I also want to quibble a little about the event study. I think the event study are very important in this case, but the results can be a little bit difficult to interpret because, as the authors readily acknowledge in the paper, it's unclear when the market learns about the post-acquisition compensation change. So, my suggestion here is that there's an alternative way to conduct this event study. That is it possible to focus on the filing date of the first proxy statement that reveals the compensation change and see, what's the reaction of the stock for these acquirers? And a couple of unresolved puzzles that lead me to think that maybe there's other stories going on. And the first one is that the compensation increase following all stock deals are concentrated in the first half of the sample. Actually, the increase is not significant at all in the second half of the sample period. And it's not just statistically weaker, because that would be that can be explained by the lack of representation in the data of all stock deals. But if you look at the economic magnitude, it's also much smaller for compensation increase following all stock deals. So this suggests that something else may be going on here that really limit how much compensation increase firm CEOs can obtain following acquisitions. So maybe there's a governance story here. I have been trying, come up with some alternative theories, but I haven't been able to. But I just want to highlight these seemingly positive results to push the author a little further in coming up with a more complete explanation of the results. And another result that I find interesting that may suggest other stories is that if you look at the mixed payment deals versus all cash deals, again, the dash hypothesis would predict that following mixed payment deals, larger compensation, there should be larger compensation increase, simply because there's the use of stock in the mixed payment deals, which would make the target shareholders more concerned about acquire stock being overvalued, which will trigger the increase in compensation and increase in equity awards. But again, that doesn't seem to be what the paper find in one of the tables. And I also have some, kind of minor empirical suggestions. Number one is, I know in the earlier studies in the compensation and acquisition literature, especially the in 2013 study, they use industry year fixed effects, but I think an alternative would be to control for firm fixed effects to better identify the change in compensation following a major acquisition. And the reason that the advantage of the firm fixed effect is obvious because it can better control for any unobserved differences between acquiring and non-acquiring firms. For example, they may be very different in terms of how they pay their CEOs or the trend in which they pay their CEOs. And then in terms of the some of the empirical proxies that the paper used to capture either acquirer, stock valuation uncertainty, or the deal risk or deal uncertainty. For acquirer stock valuation uncertainty, I would like to recommend maybe using idiosyncratic volatility or endless forecast variation as alternative measures. And then for deal risk, this is a very, very difficult variable to capture, to measure definitively. In the current set of results, the paper used ex post measure of deal risk. And I would like to suggest maybe using some ex ante measures of deal risk. And the reason is that the acquirers and the target need to make a decision on the method of payment and on the post-acquisition CEO compensation change before the deal is consummated, before the deal is playing out. So ex ante measure of deal risk may be more relevant. So I have a few suggestions here, including relatively larger deals, maybe presenting more risk to the integration, to the success of the deal, and then diversifying acquisitions when the acquirer is going out of its main industry to acquire, that represent more uncertainty or more risk. And then when the target is publicly traded, how about we use the target stock volatility as a matter of potential deal risk. So let me conclude because I think I'm kind of out of time. I think the paper is super interesting and it's very thought-provoking, and it makes me really rethink a lot about my pre-existing notions about the drivers of compensation change following acquisitions. And because of that, I think it has a lot of potential to change our understanding of CEO compensation incentives in general. And I very much look forward to seeing the next revision from Liang and Dave. Thank you.
Thank you very much, Faye. So Leon, can you take a minute to quickly reply to Faye, and then we open the floor for a question because I've received some questions already.
Yeah, so first of all, thanks a lot. That was a great discussion, and you obviously put a lot of time into it, and it's very insightful, and I appreciate it. So one comment, I think a couple of really interesting comments he made. So one of them is that, is there a substitution effect with the compensation? Are you substituting from something else to equity? And I think here it's interesting because I think we need to be a little careful about the appropriate counterfactual in this case, because we find that deals with increases in CEO compensation are riskier than other deals. And so suggesting they increase the risk of the CEO's existing compensation more than other deals. So this increase is going to decrease the certainty equivalent of their current compensation, suggesting that perhaps keeping the salary the same is actually a decrease, relatively speaking, and effectively a decrease. Does that make sense? Yeah. So I think that's a really important point, and I think we've talked about incorporating that more in the paper, and that discussion in the paper, I think he made an excellent point there. Let's see. So as far as the mixed deals, I would take the mixed deal analysis with a grain of salt right now, because the mixed deals include all those deals in which we don't have data on whether it was cash or stock. So if it doesn't say there's a percentage, and that's a large number of those mixed deals, unfortunately. We can cut those out and play with that, but I take those with a little bit of a grain of salt in that case, but I think that's a good point as well.
I see.
All right, thank you very much. I guess we should move on to the next paper and then continue the discussions later. So let's welcome Christoph. He's going to present the paper on managers listening to Twitter, evidence from M&A.
All right, can you hear me? Can you see my slides? Wonderful. All right. First of all, thank you very much for having this paper on the program. I'm excited to present. This is relatively early work, so I'm very much looking forward to all comments and feedback. I also want to thank the organizers for scheduling this last on the conference program for today, because it's 7 a.m. where I am. So it was a very, very early start this morning. All right, so the title of this paper is "Are Managers Listening to Twitter Evidence from Mergers and Acquisitions?" And after the events of the last couple of weeks and months, I don't think I need to really convince anyone anymore that social media nowadays kind of plays an important role, or can play an important role, in financial markets. Reddit firms like Wall Street Bets have been sort of associated with very, very big changes and effects in terms of AMC and GameStop. And this is not only limited to this one Reddit forum, and not only limited to the last couple of months. In fact, over the last several years, we have seen more and more that investors and market participants are sort of participating very actively in social media platforms to share information, to share their opinions, and discuss sort of what they think about certain stocks, what they think about certain firms. This includes platforms like Reddit, Twitter, and the one that I'm going to focus on today, which is called StockTwits. So we know that a lot of market participants are active in these social media networks. We also know from research and from the literature that at least since Reg FD in 2013, firms are actually using these platforms to disclose information to the public. So they're using it as a communication channel to disclose earnings news, for example, or other information to the public. At the same time, at least anecdotally, we have some evidence that firms are also monitoring the space. There are a number of professional services sort of under this umbrella of social media monitoring that allow firms to keep an eye on the conversation that is going on in social media environment, and sort of try to gauge what users and participants think about certain topics. But that's mostly anecdotal. So what we know from research is that firms are sort of using social media as a communications platform and a channel for disclosing information. But what we don't know much about, where relatively little research has been done, is the reverse direction. Does what is going on in these social media platforms affect what firms are doing in any kind of way? And that's sort of where my paper fits in and tries to fill this gap. And I'm studying in this paper how the information content, how what's being discussed in social media affects the way that managers form beliefs, specifically with respect to their investment decisions. So the question I'm asking here is, does social media feedback, the comments and content in social media, does it affect corporate investment decisions? And so this question is kind of similar or parallel to this literature on investment feedback from financial markets, and it has a similar sort of idea. We know from a lot of research that financial markets aggregate information from millions of investors and sort of put this information together in stock prices. And we've seen from previous related literature that this information that is captured in stock prices can inform investment decisions of managers and firms. This can affect, for example, M&A decisions, SEOs, earnings forecasts, and so forth. What we also know is that stock prices can be difficult to interpret in certain situations. With short selling situations, we can have manipulation of stock prices. They're subject to trading frenzies, and there can be a lot of noise in stock prices. So it can be hard to distill this type of information for managers who want to gauge sort of feedback from stock prices. At the same time, social media offers a manager the ability to just read in actual words and writing what market participants, what people who are on these platforms think and have to say about this. So as a complement to the information that's in the stock prices, social media posts might actually be easier to interpret and use as a form of feedback for managers. And that's the kind of idea, that's the kind of research question that I'm going to be testing in this paper. So turning to the empirical implementation of this, the type of investment decision that I specifically focus on is mergers and acquisitions, right? Otherwise, this paper wouldn't be on the program here today. Why do I look specifically at mergers and acquisitions as sort of a key corporate investment decision? Well, first of all, M&A transactions are really, really important, large, consequential investment decisions that firms make. And compared to other types of investment decisions that this literature typically focuses on, it has a number of important advantages and characteristics. First of all, we know exactly when this investment decision becomes public knowledge, when it becomes public news. With the announcement dates, we have information on project characteristics. We know payment method, deal volume, and things like that. And we know the ultimate outcome of this investment project. We know if the M&A decision is actually completed, or if this M&A deal is ultimately withdrawn. So this makes it really advantageous if you're trying to study if there's an effect of this feedback on this investment decision. And so my methodology, my approach follows Luo's 2005 JF paper, in which he argues that essentially managers, when they are making this type of investment decision, are using all available information before announcing this M&A transaction to decide if they want to go forward with this M&A transaction or not before announcing it, and have little incentive to make a change unless there's new information, unless there's feedback after the announcement that changes their assessment of the deal. And this feedback can take all kinds of forms. It can be actual sort of fundamental feedback about the quality of the deal itself, or it can be feedback about other forms of resistance or backlash, or other types of feedback that you can think about. And so in this framework, essentially, the sensitivity of the deal completion of an announced M&A transaction to the announcement reaction in the social media network can be seen sort of as a test of investment feedback, right? So if the deal is if the sensitivity of the deal completion to the feedback to the reaction to the feedback that we see in the social media network, we can sort of conclude that there is evidence of managers taking this information and informing their investment decision with it. Let me speak for a minute about the data that I use in this paper. So the main data source that I use to capture the social media feedback comes from this platform called StockTwits. So essentially, you can think about StockTwits, if you haven't used it before, as a sort of Twitter for the financial market, for the stock market. Every stock or every firm is represented with a unique identifier in this platform, and on every particular firm, there's sort of a news feed where people can participate and post messages about this particular stock that's being aggregated and shown to users in the form of sentiment scores, in the form of message volume and prices. So on the left, we have an example of what that could look like. A few weeks ago, Viacom CBS announced that they were about to buy Chile Vision from Warner Media, and on the chart you can see the message volume around this announcement. And as this acquisition is announced, you see the message volume go up pretty significantly. And below you can see what this news feed would look like, where people can post their thoughts and their thoughts about this acquisition and this stock in particular. All right, so from StockTwits, I obtain the raw text of each individual tweet, along with an exact timestamp of when this message was posted. My sample covers the time period from 2010 to the end of 2014 and includes about 35 million individual tweets. If you look at sort of the distribution over time, you can see that the tweet frequency corresponds very closely to the opening hours of the stock markets. From Monday to Friday, there's a lot more activities than on the weekends. The most activity is right around lunch break in New York. So it seems to be corresponding quite closely to sort of opening hours of the market. which is also corresponding to the fact that this news feed from StockTwits is integrated with a lot of financial media platforms like Reuters, like Yahoo Finance, and other platforms like that. Right, so the participants in this platform include a lot of people who are actually market participants in the financial market as well. All right, so the other data that I use in this paper is fairly standard. The M&A transactions are from SDC Platinum, focusing on U.S. Acquirers between 2010 and 2014. Announcement returns and accounting data from Crisp and Compustat. I have an additional information data source that also measures the sentiment in this platform from a professional platform called PsychSignal. And I gather news media sentiment from Raven Pack. All right, and so to test this idea, if the completion of the M&A transaction is sensitive to the feedback that the social media platform is providing, I first need to measure this actual feedback. And so to do that, I use this maximum entropy classifier that allows me to basically measure the probability that a given message, that a given tweet is bullish or bearish. That is based on the features of this particular tweet. And when I say features, I mean the word combinations and words in that particular tweet. One of the advantages of this ME classifier is that it accounts for conditional dependence. So it takes into consideration that certain word combinations can have a positive meaning, although individual words themselves would be considered negative, and sort of is sort of the standard in the related literature when it comes to classifying these types of messages into positive or negative. I also use a alternative measure, the naive Bayes classifier, which is been used in the literature quite heavily as well. One of the beautiful things about StockTwits, compared to what a lot of the related literature has done, is that it comes with a provided training sample. Essentially, users can classify their tweets and put a little tag on it that says that it's positive or negative, that it's bullish or bearish. Not everyone does that, but the ones that do allow me to use that part of the sample as a training sample for the rest of the sample. Otherwise, I would have to manually go through a number of tweets and classify them as positive or negative. With this with the StockTwits data, I don't have to do this because it comes with a basically user provided training sample. And so to measure the reaction in the social media network in response to the announcement of these transactions, I calculate the following, what I call abnormal sentiment. I use this abnormal sentiment because the average sentiment varies quite a bit across firms, so that the simple cross-sectional measure or differences in the social media sentiment are not enough sort of to capture the feedback reaction or the response to this announcement. And so what I measure is basically the difference between the sentiment in the 6 days after the announcement of the transaction relative to sort of a time period before the announcement that captures the typical average sentiment that would be typical for this type of firm before news of this announcement could have leaked. So in order to make sure that it's not sort of confounded by some kind of leakage of this announcement, I go back 7 days before the announcement. Right, so this is essentially capturing is the reaction to this M&A announcement for the acquiring firm positive or negative in this social media network. And so my main specification is relatively simple. On the left-hand side, I have an indicator variable that takes the value of 1 if this M&A transaction is finally completed, if it is ultimately completed, and 0 if it is ultimately withdrawn. On the right-hand side, the main measure that I'm interested in is this abnormal sentiment, so the reaction to this announcement. And following the literature, I also include, of course, measures of the financial market reaction, as well as firm characteristics and deal characteristics and fixed effects. All right, and so first, what I find is sort of in line with the existing literature, confirming what Luo has shown in his JF paper and others afterwards, that the announcement reaction in the financial market, the stock market reaction is very strongly related to the completion of the M&A deal. So a very positive CAR has a very strong positive relation with the likelihood that the M&A transaction will ultimately be completed. There does not seem to be any evidence of sort of a leakage, as the abnormal return before the announcement has no relationship to the ultimate completion. The main interesting observation that I'm contributing in this paper is this following one here about the social media reaction. While we have a positive reaction in the stock market, we also see that there's a strong positive relationship between a positive reaction in the social media network and the likelihood that the deal will ultimately be completed. To give you a sense of the economic magnitude, about 93% of the M&A transactions in my sample are ultimately completed, so 7% are not completed. And for a 1 standard deviation increase in my measure, abnormal sort of sentiment, this likelihood of completion increases by 2 percentage points. So relative to that 7% chance of not completing the announced M&A transaction, that's a pretty significant effect. Of course, we want to make sure that this is not just capturing other alternative explanations, and so I do a number of alternative specifications and additional controls to look at other stories that might also be explaining this effect, or to dig a little bit deeper. First of all, Yo and McConnell have a paper that shows that M&A completion is sensitive to the reaction in the news media, in the newspapers. And so to control for this, I include an additional controls for the reaction, the sentiment in the newspapers and in the sort of classic news, not social media, but classic media. And I find evidence that is very consistent with the paper. There's a strong positive relationship between the reaction in the news media and the completion of the deal. But the effect that I document on the social media reaction is basically unaffected and remains very strong. If I use an alternative measure based on this naive Bayes classifier, I find a very similar result. Still very strong positive relationship between this social media reaction and the likelihood of deal completion. If I want to also control for the stock market reaction with respect to the target firm, I have to limit the sample to only public targets, which reduces the sample size quite a bit. But in that smaller sample, I find an actually stronger effect of the social media feedback. So the effect is there as well. If I focus on those types of deals where there were at least 15 postings, so where there was a larger number of postings, the effect is stronger again. And if I estimate this alternatively with a logit specification, I find very similar consistent results. I also use this alternative data set from PsychSignal and find similar results there as well.
Sorry to interrupt, but you have about 5 minutes.
That's perfect. Thank you. All right, so to dig a little bit deeper into this and study the channel and the plausibility of these results a little bit more, I look at cross-sectional differences in these M&A deals along two sort of main dimensions. The first one is with respect to tweet informativeness. So if it's indeed true that firms, that managers form their beliefs based on this feedback that they receive from social media, then we should find a stronger effect if this feedback is louder, right? If this feedback is more prominent, and the posts that that react to this M&A announcement have a higher visibility, have more attention to them, and have a higher sort of credibility and generally what we would call clout in social media. And so to test this, I calculate the average number of likes that tweets receive in response to these M&A announcements. I look at the average number of followers of the people who talk about this particular M&A transaction, and I look if there is an official account status. So if there's verified accounts with sort of likely a higher credibility and a higher visibility that we're tweeting about a specific M&A transaction. That's the first dimension that I look into. The second dimension is related to stock price informativeness. The idea here is that if this is indeed a story about social media providing some kind of feedback that adds additional information that cannot be gleaned from other sources like stock prices, this effect should be especially strong when these other information sources are weaker. Right. So if what we call learning from stock prices is less likely or is more difficult to do because stock prices are less informative, then other sources of information such as social media feedback should be relatively more important. And so to test this, I use 3 different measures: the price non-synchronicity, the probability of informed trading measure, and the absolute value of the stock price reaction of the car, in a sense that if there's almost no reaction in the stock market, there's also a very small signal to inform managers' decisions. So I modify my main specification a little bit by interacting the main measure, the abnormal sentiment, the social media reaction, with an interaction with these characteristics. And I include these characteristics that I have here by themselves in this specification as well. All right, everything else stays the same. All right, so looking first at this cross-sectional characteristic of tweet informativeness and how sort of prominent, how visible, how much attention do the users have that are tweeting about this. I find evidence that is consistent with this idea that this is stronger and is more pronounced when the tweets receive more attention, when the tweets are more visible, and generally more likely to be seen by decision makers. So this effect is stronger in the cross-section when the number of likes is higher, when the number of followers is higher, and when there are official users with a verified profile that are talking about these announced M&A transactions. All right, so this is consistent with this idea that this is sort of an information source because the tweets that receive more attention are the ones that are seemingly driving this effect. Similarly, looking at sort of the social media platform as an alternative source of information and the interaction with stock price informativeness, I find similar results consistent with this idea that the social media platform provides sort of a source of feedback, particularly when the stock price feedback is likely to be less informative. So the interaction between this abnormal sentiment with measures of stock price informativeness across these 3 different measures. So first 2 columns, it's the non-synchronicity measure. The second 2 columns, the probability of informed trading, and the columns 5 and 6 will be the absolute value of the stock price reaction, are all negative and significant, indicating that this effect is weaker when the stock prices are particularly informative. And this effect is similar if I use the StockTwits platform and data, the raw data that I use to construct my measure as sort of the main data source to measure social media sentiment, or if I use the PsychSignal platform as an alternative way of measuring this social media sentiment. All right, so to summarize, I think I'm pretty much at the end of my time. What do I do in this paper? In this paper, I study this question: how do managers form beliefs? Specifically, sort of how does social media feedback factor into their beliefs, with a focus on corporate investment decisions. So does social media affect sort of real outcomes, the things that firms invest in, the firms do? And in this paper, I focus on M&A transactions, particularly because they allow me to observe both the exact sort of announcement of an investment project as well as the ultimate outcome of that investment project. Right? What I find is that the completion of an announced M&A transaction seems to be very sensitive, or seems to have a sensitivity to the feedback and the reaction in social media networks to this M&A transaction announcement. This is robust to including the stock market reaction to including traditional media reaction and deal characteristics, right? So while there is clearly an overlap between the social media feedback and the stock market feedback, those two things are correlated. It is not, the social media feedback is not simply a reflection of the stock market feedback or the stock market reaction to this announcement. And I additionally, when I look at the cross-sectional differences, find that this is stronger when the tweets that are sort of that are occurring around the announcement are more influential, are more visible, and when the stock prices of the firms, of the acquiring firms, are less informative, consistent with the idea that this has something to do with social media serving as sort of a information platform where managers can glean information about these investment transactions. All right, thank you very much. I am looking forward to the discussion and the feedback.
Thank you very much. I'm very relieved. I thought you still have 7 slides to go. So let's welcome Mary to discuss the paper.
Thank you very much for inviting me to this great conference and for the opportunity to discuss this very interesting paper. So Christoph did an amazing job presenting the paper, but if I want to summarize the paper just with one sentence, he looks at whether social media affects managerial actions or corporate investment decisions, because prior literature looked at how firms and managers can use social media to communicate with investors. So this is the reverse direction. Is there any learning from social media which could be important for investment efficiency or investment outcomes? And he finds that for announced M&A transactions, negative social media feedback increases the likelihood that an announced transaction gets withdrawn. And the interpretation, this is that sentence in quotation marks, is coming from his paper. So he interprets his finding as managers using signals and feedback from social media to help guide their corporate investment decisions. And that sentence would be important for my discussion. That's why I put it the way he put it in his paper. So this is a very interesting paper, really clearly explained, very well written and presented. So I would have kind of 3 comments or 3 points about some of the things which are not very clear to me, and maybe also some other potential directions which could actually enhance the contribution of the paper. So let me go to my next slide. So there are more than one reason why M&A transactions get withdrawn, right? So one is regulation, due to regulation and antitrust, right? Second is sometimes an announced deal gets withdrawn because there's a competing bidder. Sometimes, as Christoph mentions, investor reaction is too negative. Or, for example, in my own work recently, I looked at activist hedge funds. They are very important in telling managers or firms to withdraw deals that they announce because they don't like empire building firms or they don't like large acquisitions. And also the last point, I don't think it has received attention in the literature, but it is possible that, for example, a firm announces an acquisition. It could be a debt financed acquisition or a stock financed acquisition, but right after the announcement, stock market could move in a unfavorable direction, overall market, and that could affect the acquirer firm's ability to raise financing, and the transaction could be withdrawn. So this would be similar to IPO withdrawals. There's a lot of literature for IPOs showing that, unexpected short-term large stock market fluctuations would lead to withdrawal of IPOs. About 25% of IPOs are withdrawn because of this reason. And so I would like to see in the paper, I think if Christoph can provide us with a little bit more information about, what are the percentages in these withdrawal cases. The reason is like regulation or antitrust or a competing bidder or the last two. So I could see the last two reasons here, investor reaction or an activist hedge fund involvement, being related to, managers learning more about these two drivers of withdrawal from Twitter. But if the drivers are the first and the two, I don't see much content for Twitter or social media to affect withdrawal decisions. And also, as Christoph said, only 6.2 or 6% of deals are withdrawn. So I think it is really important to clarify this point, why we see withdrawals. And let's say, actually, it's not antitrust related. It is not competing bidder related. So again, I would like to ask Christoph to tell us a little bit more about, what is it exactly that managers are learning from Twitter? Because he argues that, and I agree with him, that tweets are easy to read and understand because they are short, right? They have maximum 140 characters. But precisely because of that, is it likely that they would convey material and novel information that firms or managers didn't have? And again, I like Christoph's paper because he says these are largest, most visible, most consequential investment decisions. So that means that, managers would do a lot of homework before actually announcing these decisions. So they would know a lot about firm-specific factors, industry-specific factors. They would know a lot about the target, deal characteristics before they announce these deals. So then I think it is a little bit hard for me to see what they would learn from Twitter, especially if we have short tweets. And it could be a sentiment story. I think Christoph told a lot about sentiment, like what people or potential investors are thinking about this deal. So it doesn't have to be, like very thoughtful or insightful new information. But even in that case, I need a little bit more clarification because again, the deal is announced, right? Let's say investors reacted very badly to that deal and there's a lot of negative sentiment. So what is the incentive for the manager to withdraw the deal at that point? Because the damage is already done, right? And he doesn't exactly know who are these participants on the platform who say negative things. And I think like an analogy is like we present our papers in conferences, in seminars. There's a lot of sometimes negative feedback or negative sentiment, but most of the time we don't quit, right? We incorporate that. We learn from that negative feedback. If we cancel, it is not, I don't see how that is going to help us. But that negative feedback still could be useful. So I would like to understand that better. And also, one other kind of clarification I need is that suppose that we are learning things from Twitter, but then wouldn't that be a reflection of what is actually argued by the management, by the firm, provided to the investors, or around the announcement, investors react, right? Large institutional investors and hedge funds react to these deals, or competing firms, or employees, So then is it that Twitter is providing that information in a similar format to us, or is it really something new in Twitter? I think that is important. And sometimes there are bad deals driven by empire building motives or managerial private interests. And even in those cases, I am thinking like large investors, activist hedge funds would play a bigger role than Twitter users or newspaper journalists. So in a way, I think newspaper journalists or Twitters would get that information and they would convey this information in short tweets to the rest of the investment community. And I think clarification would be important here. What is exactly that managers are learning from Twitter, right? So then if we obtain or if we observe a positive relation between abnormal social media content and withdrawal likelihood, so that makes a lot of sense, because again, continuing on my previous comment, this would be social media content would heavily depend on what we observe as announcement returns, who are the investors, what they say, and whether there's a competing bidder, and how it affects our likelihood of winning this target firm, and what might happen in the overall stock market in terms of the acquirer's ability to complete that deal. But then that positive relation or correlation may not imply that managers are really learning something new that they didn't know before, and they go ahead and they cancel the deal or they withdraw the deal. So I think actually, so I like this paper a lot, and I like this research direction. And I'm thinking maybe, there is another role for social media or Twitter to affect M&A outcomes. Maybe it is an ex ante role rather than an ex post role, right? Ex post in the sense that deal gets announced and what happens in Twitter affects whether the deal gets completed or not. But an ex ante, I think Christoph can maybe do that with the amazing data that he has. So we can look at, for example, the same way he does, if there is an abnormal increase in negative sentiment about a firm, right, or positive sentiment about a firm, other firms or managers could actually use that information to find themselves potential targets. It could be a firm, let's say, experiencing financial distress or financial constraints. It could be a private firm which obtained a patent or which generated an innovation and needs somebody to convert that innovation into a patent. It could be a firm which actually lost its key human capital. So I'm thinking that could be also a very interesting, I think, mechanism where social media could affect firm investment decisions. And I think there is already a paper, a working paper, which shows that social media content about a firm affects the firm's likelihood of becoming an activist target. So this could be done in the M&A context as well. But what I find also very interesting is what Christoph talked about in the final part of his presentation. So he explains in his paper very nicely that, there is some research showing that with the improvements or developments in social media, some like stock price informativeness of firms has changed, right? So there is research showing that firms, especially larger firms with greater social media coverage, they experienced an increase in their price informativeness. And this could be a reason why actually firms, for example, could use now their stock more easily as an acquisition currency, because that improvement in stock price informativeness mitigates adverse selection regarding acquirer's stock price, whether the acquirer is acquiring a firm because they know that their stock price is overvalued. So then if we have less asymmetric information about the acquirer's true value, that could expand the set of stock finance transactions. I think that could be a very interesting testable hypothesis. And also there is another one, because Christoph also cites other research which shows that for smaller firms, it is the opposite. Maybe, like it's very easy to generate low quality information about firms, and that reduces the demand for high quality information production. And I could imagine maybe now deals involving smaller firms with a lot of social media coverage, they are going to be less likely, because it's the opposite story now. We have much severe adverse selection about the true potential value of those target firms. I think this could be a very interesting direction or other hypotheses that Christoph can examine with the data that he has. And the other comment is that Christoph does a very good job in covering prior work about what affects M&A withdrawals, and is it the announcement returns, is it media coverage, traditional media coverage? And there is quite a few papers, there are quite a few papers showing that traditional media affects investment decisions. I think here I would like to see a little bit more kind of justification or motivation in Christoph's paper. Okay, we know that media is important, right, for a lot of things, for finance in general. But then is there anything, or is there something special about social media? And again, here with his data, right, he has data about like a user, how many other users he's connected to, how fast these tweets reach other users, how big the network of the user tweeting about an M&A transaction. So then maybe he could tell us a little bit more about why we care about social media as opposed to traditional media. And so maybe again, it's the speed story or accuracy story. But on the other hand, again, when I teach my MBA classes, I read a lot of interesting articles in New York Times and Wall Street Journal about deals, like future deals, as well as past deals, as well as current deals. And I'm thinking there is really a lot of content one can learn from a newspaper article about an M&A deal. So then Twitter is good in terms of, conveying messages very fast to a large number of users. But on the other hand, is there a lot of content? Is there a lot of information? And I think that kind of assessment of the traditional media versus social media could increase, I think, the appeal of this paper. Maybe there is something that social media can achieve that traditional media cannot achieve, or there is something bad about social media which leads to announcement of a lot of deals, and then maybe that these deals are not that great. I think that could be an important part of the story. So as a conclusion, I like it very much because clearly there is really no work. There's only that activism paper that I know about how social media affects managerial decisions or managerial actions. And Christoph's data is amazing. His paper is very well done. But I would like to, again, know a little bit more about what is it that managers learn from Twitter? Is it like new information? Is it sentiment? And also, given that only 6.2% of announced deals are withdrawn, again, that goes back to my initial point, we don't quit our papers, right? So it's the same story. So that gives me a little bit more hope for perhaps examining ex-ante relations between social media coverage and investment outcomes could be an interesting direction. So I already talked about this, but this price informativeness, what happens to price informativeness due to increased activity in social media, that gives very clean and interesting predictions about M&A outcomes. And lastly, what is special about social media? If I know about media in general, what are the reasons why I would like to study in this paper, social media? I think this is all I have. Overall, very well done paper. I recommend everybody takes a look at it. I really enjoyed reading it and thinking about it. Thank you very much.
Thank you very much, Mary, for your discussion. And Christoph, can you take a moment to reply to Mary, and then we open the floor for Q&A.
Yeah, Mary, thank you so much for this incredible discussion. Very, very valuable feedback. I'll have to ask you for your slides later because I think I want to include everything you said in the paper. Just to pick up on a few of your comments, I think you're completely right about the fact that currently in this form, I can really not properly distinguish between, is this actual fundamental information, or is this some sort of sentiment that is being conveyed and captured in this reaction? I think the previous literature sort of has evidence of both, in the sense that if you look at the stock reaction sensitivity, the stock price reaction, that would indicate that there is some fundamental information that the market can figure out, that the managers, despite having done all this due diligence prior to announcing such an M&A transaction, are not able to understand. And there's also the other component that you also talked about, that managers might be doing empire building, and the feedback that they receive, for example, from traditional news media is that, hey, you're not getting away with this empire building. We at the news media have sort of a governance function, and we're going to let you know that this is a bad deal, and we're going to put attention on it. And so you now have to react and sort of withdraw this. I think that there's probably a bit of both of those things. It's tough for me to disentangle those two things with the sample I have. This is the main thing I think I'm working on right now, is just extending the sample, because the main limitation is the relatively short period, which limits me to relatively few of these transactions. So if I can extend the sample to today, it would give me a lot more observations to work with, that would hopefully allow me to address exactly this type of thing. When it comes to sort of the differences between social media and traditional media, I think you already pointed to a lot of very important differences that I think would be very interesting to dig into a little bit more. Like you said, there's a speed component. I think one of the very interesting things is the interaction ability. You can reply, you can interact with the person, which you cannot do with the newspaper journalist. And you also have the fact that obstacles to participation are completely different. The people who are able to write newspaper articles, and their sort of background and their connections with the firms are very different compared to the average person who might not have the ability to use these types of channels to convey their insights or sentiment or information that can be picked up in a social media environment. So I think those are probably two avenues to explain the things that you pointed at, and I hope with a larger sample I'll be able to do that.